and it's 2:45. We are right now in another episode of Blockrevision, in which I will make an educational tweak, inside of which we'll make an assumption where the US and the global economy may be going due to indicators and also the road that I will show you up in the next window. So let's get into first thing, and that will be the one of the most important aspect of today's episode will be a roadmap for how the economy responds to changes in rates, and this one is already been mentioned in previous episode but needs some clarification and also ponder about. So if we just have a look at this one, we will make an assumption that if all of these criteria will turn up in the economy, will have a recession. This path is not maybe the only one that may lead to a global slowdown, but is definitely the most common that happened in the past. So we have NHB, permits, ISMs, confidence of customers. We have consumer numbers, manufacturing sales, capital goods, industrial production, AWH, also have payrolls, personal income, and core CPI. So on your left you have the most important leading indicators. However, on your right we have lagging. So if we just make a closer insight in what's going on in the economy of US, we just have a look at trading calendar, and in US since 26th of July, so that's the whole spectrum of events of previous month. We have at first case-share home prices, new home sales, consumer confidence, and so on and so forth. With this, we may analyze what the outcome may be, and when is the biggest probability of recession to occur. So with this NHB, at first we have NHB at 49 points, so it means we already dropped below the area of a strong growth, and the housing market right now is showing a slowdown, a real slowdown after this abrupt change in 2021, right after this pandemic slope. So it's one of the most important factor in which we may consider that the slowdown already may happen within next few months. As a hope cycle appoints, we may find that this NHB may proceed and likely recession within up to 24 months. So if we have NHB slowing down, that may be first sign that this slowdown may be closer than 2 years from now. But let's have a look at permits. So on permits, we have building permits that are right now appointing that on a 10-year time time horizon, we also forming a double top. So normally it's a first of a more important sign that the for this sector that might be a bigger slowdown. So it's permits, and right after we have ISMs. In terms of ISMs and also PMIs, we are jumped over 50ish. We already right around 50, 55. So it's not a very much of a slowdown yet, but we need to be very cautious as this slide is very abrupt. On ISM non-manufacturing PMI, we may find that we are rebounding out of this 55 area. And let's have a look at PMIs then. S&P Global Services PMIs right now getting lower, below 50ish. So it's an obvious sign that that's an HB. This is an obvious sign that we are right now going into a likely recession. So there are many viewpoints around. We may consider whether we are in a recession or not. Due to some Fed's economists, it's not yet, but as you can find, more and more indicators are just pointing we are right there. In terms of confidence, that also something that by consumer confidence showing that we are sliding, maybe not in a very much pace, but sliding constantly throughout recent months. In terms of consumer sentiment, we are eventually have rebounded out of this very lowest ever 50ish points been registered, and in consumer CB, that's the consumer numbers. Manufacturing sales, so also let's have a look. So manufacturing PMIs, we haven't looked at NY Empire State Manufacturing Index and also Philadelphia, so let's get into, and those are showing obviously that we are right somewhere around recession areas. Philadelphia one is rebounding, but still has much to catch up. So we are finding that among those elements, those whole elements, we are right now in a territory of a possible slowdown somewhere around new orders level. So that means we are still before an eventual slowdown of profits and employment. So why really Fed is looking at employment as one of the key features in terms of whether they can go for or against in this interest rate hike cycle. That's if you'd like to make a comparison to moving backwards. We don't want to see slowing down in housing markets and orders. However, watching at employment and considering everything as fine. Yeah, everything is fine, but as it was back with inflation, by them that was throughout a couple of months transitory inflation that were about to be stopped, but it only got worsened due to their indifferential posture. So that's very, very bothersome. Right now, this episode is focused mainly on this aspect, as we need to ponder this over, and we will study this chart in the future as well, in order to qualify in which of these states of hope cycle we actually are. So today, that's it in today's a little bit shorter episode. Hope you found it interesting, and as always, I invite you for another one every working day at 2:45 p.m. New York time. So see you there. Thank you.